what lessons come out of this crisis for the future of economics. In fact, some people have suggested that in many ways the crisis is to simplistic market fundamentalism, simplistic market economics, what the fall of the Berlin Wall was to communism. Fall of the Berlin Wall marked the end of. Everybody knew that the communist system was flawed, but it was a defining moment in which it became very clear. And some people think that September 15th, it will historically be similar to that as a defining moment in which certain economic doctrine, certain economic views that had prevailed for long periods of time, which were recognized to be flawed, became really, that became very apparent. So the basic notion what I want to go through is that the current economic crisis has many lessons for economists and for those who study economics. It is probably the most serious economic disturbance in the U.S. since the Great Depression. I don't think there's any doubt about that. Just as a matter of review, most downturns since the Great Depression have been of one of two sorts: either inventory cycles, where businesses accumulate a little bit too much inventories, and then they discover that they then have to decumulate the excess inventory, and when they've done that, the economy starts up again. The other major source of economic downturns are central banks. The Fed steps on the brake too hard, worried about inflation. It's always been a reckless driver. And more recently, it's been extraordinarily reckless, and we'll come back to that later. But it steps on the brakes too hard. The economy comes to a screeching stop. It recognizes that it made the mistake. It takes its foot off the brake, puts it out a little bit on the accelerator, and the economy recovers. This economic downturn, by contrast, is a result of a major financial mistakes in our financial markets, which have devastated our financial markets. In a way, it's a little bit like the S&L crisis 2 decades ago, but it's a worse version. That crisis led to a 1991 recession. This is obviously a much more serious one that is likely to lead to we don't know how deep this is, but it's likely to be very serious. Those of you who are first-year students are a little bit better advantage. You'll have at least 2 years before you enter the job market. I don't envy the second-year students. This is a global seminar on global economics. This crisis has now become a global crisis. Earlier, particularly in Europe, there was a lot of discussion of a myth of decoupling, a notion that in a world of globalization, China, India would fill in the gap. America was weak, but the other sources of strength. That was, to me, always a myth. China, India were very dependent on what happened in the United States. Global financial markets are very integrated. The meltdown of the American financial market led to a meltdown, constraints in all financial markets. And now the effects have spread all over the world. In the case of Europe, it's really quite interesting because they have suffered partly because of major financial losses. And part of the financial losses are a result of the fact that we exported our toxic mortgages, our bad mortgages, to Europe. I've often said we were very thankful to Europe because if they hadn't done it, the economic downturn in the U.S. would be much worse. So the fact that we were able to export not only export our deregulation philosophy, which opened up the markets to our bad mortgages, has made it, we're very thankful that Europe followed us in making these mistakes because it helped diversify the risk. And then the third part is that the world is integrated with respect to trade. We for a while in 2008, forestalled the magnitude of the downturn by increasing our exports with a period of very low exchange rates. But by the same token, that hurt Europe and started Europe going in its downturn. And now Europe is probably is clearly in large parts of Europe are in a recession. The effects are now spreading to the developing countries. One of the ironies is that money is flowing back to the United States, and this is making many developing countries very almost angry, because they said, this is a case where the crisis began in the United States. It was America's bad lending practices, bad banking, bad regulation, and yet money is going back to the United States. One of the interesting things, I don't know if any of you looked at, bother to read the G20 communique that came out. At the last paragraph of the communique, the United States and the advanced industrial countries offered to give technical assistance to the developing countries to help manage their central banks and their regulation. I'm the chairman of a global UN commission that's looking at reforming the financial regulation. In a draft of the communique, I put in a statement that the central bank governors of the emerging markets, many of whom have done a fantastic job. I mean, if you look at actually the way they had put in regulations over the last 5 years, 10 years, it's really we should be embarrassed. They did a really fantastic job. So I put in this draft communique that the emerging markets offer to technical assistance to the United States to help it reform its banking system. Unfortunately, it's interesting, the central bank governor of a couple of the emerging markets noticed this little thing that I had put in. I hope nobody would notice it. And they said, no, this is a little bit too embarrassing, and we may get beaten up if we go back home with that. So it did get taken out. But it does highlight the fact that even countries that were doing relatively well are facing serious problems. I saw the data that just came out from Brazil, for instance, that Brazil, which prided itself on actually doing very well the last several years, last month had job losses of 650,000. So they look like they're going into a very serious downturn. There's a little bit of mystery of why money is flowing back to the U.S., but I think there are at least two parts to it. One is because there are asymmetric effects of symmetric policies. If the U.S. has now provided guarantees for our bank deposits, for our money market funds, and if a small developing country offers a guarantee to its bank deposits, investors it doesn't have the same credibility. They know the U.S. will stand by it. They're not sure that their own countries will. But it's also partly because there of a long history of asymmetric policies that this crisis has brought out into the open, and again resulting in a lot of resentment in the developing countries. Remember, just a little over 10 years ago, there was a crisis in East Asia. In fact, it became a global crisis, 97, 98. And the United States Treasury was particularly forceful, and the IMF, in demanding that these countries, the affected countries, engage in pro-cyclical monetary and fiscal policies. That is to say, they insisted that they raise interest rates and raise taxes, cut back expenditures. And when I say raise interest rates, I mean really raise interest rates. In the case of Korea, they raised interest rates first to 25%, but then the IMF said, you have to be serious, you have to raise them to 40%. In the case of Indonesia, they anticipated this. They raised them first to 22%, and the IMF said, no, you obviously don't understand good economic policy, and they forced them eventually to raise it to 80%. Not surprisingly, 50% of the firms in Korea went bankrupt, 75% Indonesia. So this is the kind of what we did 10 years ago. What are we doing in Europe and the United States today in the face of the crisis? Of course, we're lowering interest rates to close to zero, engaging in massive countercyclical fiscal and monetary policy.
What does that mean? It means that in developing countries, there's a lot of volatility because they have pro-cyclical that exacerbates the fluctuations, and in the developed countries, you're reducing the fluctuations with counter-cyclical policies. And what's remarkable is that the IMF has learned a little bit. In the case of a few countries, it has said that it will tolerate counter-cyclical policies. But in a number of countries, Ukraine, one of the Baltics, and Pakistan, it has insisted on pro-cyclical policies. It seems to have a pro-Taliban policy. I don't understand it, but the general point is that pathology teaches us a lot of lessons. In medicine, you often learn a great deal by studying people who are very sick. And so that's what's, for an economist, this is really an exciting period. That's right. If you're not in the job market, I should have said that. It's an exciting period. I mean, this is really, we've come into our own. People ask us for our advice. Finally somebody's paying attention to us a little bit. The Great Depression led to a lot of new insights. And it's a little bit difficult to put yourself in the mindset of what the economics profession was back before the Great Depression. But even in the middle of the Great Depression, the American Economic Association, the consensus of the economics profession was that what the government should do was to have a balanced budget, not to engage in counter-cyclical policy, not to have a stimulus. And if any of you read Galbraith's memoirs, it's very interesting the fight that he had at Harvard. That it was just he was viewed as a real aberration. So, but today the notion, somebody said we're all Keynesians now. The notion that in an economic downturn, government needs to do something is pretty well accepted. And there's a general understanding that markets are not self-adjusting, at least in the relevant time frame. And when I say relevant time frame, there's a famous quip that economists used to say, well, markets will eventually adjust in the long run, to which Keynes replied, yes, but in the long run, we're all dead. So the point is that you can't wait for markets to adjust. Well, I think this crisis is going to similarly bring out a large number of lessons. It's going to bring in, it's already drawing lessons, for instance, that many of the standard macroeconomic models really didn't fully explain what was going on. And it's interesting, there is a strand of research that is really quite different from the models that are focused on real wage rigidities, but focused on financial sector problems as generating cyclical fluctuations. Irving Fisher, Chaim Minsky were among the people who have developed these ideas, and they are beginning to get a lot of attention. But what's so interesting about this crisis is it combines macroeconomics with microeconomics, because, as I say, it's clearly been a problem in the financial sector, and it raises questions such as, are markets really as efficient and innovative as market advocates claim? How do we explain these obvious market failures? Imperfections of information, irrationality? One of the things I'm going to try to argue is all of the above. That there was a lot, we can explain a lot by imperfections of information, but you can't explain everything. You really have to go beyond that to models of irrationality. Traditional finance theory, in some ways, got us into many of these problems, as I'll try to explain. And what I hope to do is to, by the time we come to the end, talk a little bit about what we should be doing and why what we've done so far hasn't worked. Before getting into this, I want to just make a couple more general theoretical remarks, about economic theory. one of the things that happened after the Great Depression was, the Great Depression obviously suggested that something was wrong with free markets. Markets by themselves hadn't worked. 1 out of 4 people were unemployed. Something was wrong. But economists love the notion that markets work well, and the question is how to reconcile the two views. And the approach that was taken and dominated for over 50 years was called the neoclassical synthesis. It was based on the notion that once markets were restored to full employment, the neoclassical principles that markets were efficient would prevail. What's so interesting is this widespread belief. It was in textbooks, it's basically pervasive in the profession. But it was a religious belief, not a theorem. It wasn't based on empirical evidence. It wasn't based on any theorem. It was just a belief that became widespread. It's really a subject for the sociology of knowledge. Why did everybody come to believe it? But they did. In fact, the idea, I think, was always suspect. What it said is that what it said was that market failures only came in big sizes. That is to say, you had disaster, which you couldn't ignore, like the Great Depression. But if you don't see a disaster, everything is perfect. Now, in fact, it's much more plausible to say that there are lots of failures, some small, some big. When it comes to a Great Depression, you can't ignore it. You have to admit it's there. But a lot of the smaller ones are just as important, but harder to verify. And in fact, I've written several papers where I try to document some of these examples of market failures. For instance, the fact that there are a whole set of examples called tax paradoxes, where you can see very clearly that American firms all over the world, pay billions of dollars in taxes beyond the level that they need to do. And you have to explain why. You know, it's not that complicated. All you have to do is read 15 books, and you should be able to figure this out. You know, it's not like you have to. Tax technology is relatively simple. So the notion is that the Great Depression or recessions are just the tip of an iceberg. There are many smaller market failures. And one of the research agenda is to try to understand what causes them. Now, there's a general theorem about market failures. The idea that markets work well is a very old idea, of course, that goes back to Adam Smith. That he argued that individuals, firms, in the pursuit of their self-interest, maximizing profits, in competitive markets, were led as if by an invisible hand to economic efficiency, to some notion of general well-being. Okay, and he articulated that actually in his book Theory of Wealth of Nations in in 1776, and it wasn't until actually 1950s that it was proven by Ken Arrow and here at Stanford and by Gerard Debreu. But like any theorem, there are lots of assumptions, and some of them are very critical. One of the important assumptions is that information is perfect and markets are complete. You get insurance against every possible risk, perfect competition, and so forth. And what I showed with my colleague Bruce Greenwald was that the reason the invisible hand often seems invisible is that it's not there. That is, to put it technically, that markets are almost never Pareto efficient. They're, even taking into account the cost of information, the cost of collecting information, the cost of creating markets. That is to say, there always exist interventions that can make everybody in society better off. So that's the general theoretical problem. And markets, financial markets, these problems become very important because financial markets are essentially markets about information. They're markets where imperfections of information are essential, And what we are seeing is a massive failure. What I say, this is a massive microeconomic failure leading to a macroeconomic problem. Financial markets are supposed to allocate capital and manage risk. But in fact, our financial markets misallocated capital. It spent hundreds of billions of dollars in housing beyond people's ability to afford. If you want to know what is the real failure, the real losses, that's the real loss in our society, plus the real loss in GDP because of the economic failure. There are winners, there are losers from all the gambles, lots of transfers, people winning and losing money all over the place. But in terms of resource allocations, the real cost of the financial mismanagement is the misallocation of resources and the economic recession that we're going into now. Well, one of the important things to remember is that for the most part, financial markets are a means to an end, not an end in themselves. That is to say, they are an intermediate variable. They're supposed to make the economy more efficient. By managing risk better, they are supposed to allow people to take on more risk and therefore take on higher expected return activities. Okay? So the notion is that it's an intermediate institution, an intermediate sector, the function of which is to increase the real output of our economy. But it didn't do that. And what's so remarkable is that if it were doing its function well, high productivity in this sector would have meant that it would have performed these tasks at low transaction costs. But in fact, it prided itself in being big. 40% of corporate profits, 30 to 40% in recent years of corporate profits have been in the financial sector. And that doesn't include their bonuses that they were paying out. Now, that should have been a symptom that there's something dysfunctional. If something that's an intermediate variable is doing this, unless you could show that it really was increasing productivity, then it was a sign of inefficiency, not a sign of efficiency. Now, it's important, and particularly here in Silicon Valley, to recognize that the financial sector, parts of the financial sector have performed a very important role. I think the venture capital has performed a very important role in channeling money into new ventures, into high tech, into starting new industries. But that's not what most of the people on Wall Street were doing. Most of them were engaging in gambling and other kinds of activities I'll explain a little bit later. One of the things that's important to realize, we get focused here in this crisis right now, but this is only the largest and most recent financial crisis and bailouts. They've been coming every couple of years. We had in 1989. We had the S&L bailout. In 1994, we had the Mexico bailout. Then we had the bailouts in Brazil, Korea, Indonesia, Argentina, Thailand, Russia. You can go on. It's a long list. Now, most of those bailouts have the name of a country. But don't be fooled by that. It wasn't the country that was being bailed out. It was Wall Street that was being bailed out. That in the case of the Mexico bailout, for instance, what happened? Many people in the financial market bought Mexican bonds. They made a bad judgment about credit worthiness, and that's a characteristic of each of these. There was a bad judgment about credit worthiness. Mexico couldn't repay. So what happened? The U.S. government gave money to Mexico, lent money to Mexico to repay Wall Street, and then the Mexican government had to pay the U.S. government. So Wall Street got the money, and the Mexican people wound up paying the bill. So these are examples where governments, in the other cases it was foreign governments who've borne the cost, this time it's the American government who's borne the cost. And that's the only difference. All of them represent a failure of assessing credit worthiness. In many of these cases, I think it can be argued that, I wrote a paper when I was at the World Bank arguing that actually Mexico would have been better off had we not bailed out Wall Street. And I want to say very carefully, we didn't bail out Mexico, we bailed out Wall Street. And if we had just let those bonds go into default, Mexico would have been better off, and the cost to the people in Mexico of that was enormous. I want to say a word about innovation because I'm sure run out of time before I get to the end of this. But one of the big calls are for more regulation, and one of the counterpoints is that regulation will stifle innovation. But I think it's important to understand that the financial markets really weren't very innovative. They did not create risk products that would have enabled individuals to manage the risk which they faced. In fact, if you look at the innovations, much of them were involved in what I call tax, regulatory, and accounting arbitrage. For instance, regulatory arbitrage entailed finding ways that you could get F-rated mortgages be put into fiduciaries like pension funds by converting them using financial alchemy to somehow get a blessing. How do you convert an F-rated mortgage into an A-rated product that you could put in somebody who's supposed to be very prudential? So that was clever. It didn't work, but it was very clever. And the other is accounting innovation, finding out ways so you could obscure so that not even the banks knew their own balance sheet. That was a real achievement. So they originally began by trying to deceive their investors. They wound up deceiving themselves and, in the end, causing a complete credit freeze. So that was innovation. But they actually resisted innovations that would have made markets work better. And there's a long history of this. Just to give you some examples, when I was in the White House, I tried to introduce inflation index bonds. One of the real risks that people care about is inflation. And if you're saving for retirement 30 or 40 years from now, you might say, okay, we're in a low inflation environment today, but who knows what happens? You know, American Electric sometimes elects very peculiar people as president, and some of the choices of central bank governors have not been impressive. So you could wind up, you know, anybody looking at recent history, who knows, we could wind up with inflation. So it's something you ought to worry about. So it's a risk. The market has not provided any insurance against that risk. So we said we ought to be able to provide that insurance. It's a social good. It would make people more secure for their retirement. And we thought we could make money out of it. So I proposed coming up, issuing inflation index bonds. And there was an enormous pushback from Wall Street. And I was curious why. And eventually I found out the reason is there were experiences in other countries like the UK where they've been issued where people bought these bonds and then just kept them. Why trade them? You know, they were perfectly, they were risk-free. So Wall Street didn't make any money because the way they make money is people buying and selling. And so they said, this is not a very good product. It doesn't generate transaction costs. We like transaction costs. And so they fought the creation of these inflation index bonds. Eventually we succeeded. It was not easy, but we got them issued. They were issued in 1994. Argentina, in the aftermath of its crisis in 2001, wanted to issue GDP index bonds. The argument was very simple. The question was, how much could they pay their creditors? And what had happened historically in the case of creditors is the IMF goes in and says, you have to pay your creditors an awful lot. And they always say you can pay them more than they can repay, and 5 years later there's a crisis, another crisis. You look at the history of crises, if you have one crisis, you have another one a little bit later. So what Argentina said, we don't want that. What we will do is issue what might be called an incentive-compatible bond. What we will do is issue a bond that says if our GDP goes up, we'll pay you more. If our GDP doesn't go up, we won't. So it was sharing the risk. It was actually, from a risk management point of view, a very good product. Wall Street hated it. It resisted it. Eventually they got it issued, but it was not something that was well received. The market still has not made available mortgages that would have helped individuals manage the risk which they face, which is one of the reasons why millions of Americans are now losing their home. And there are alternatives that can do a much better job. Denmark, for 200 years, has had a relatively good system called Danish mortgage bond market. What is interesting is when they proposed extending that to other countries in Europe, the rest of Europe said, we need 10 years to adjust. You're too competitive. And they put constraints on the issue, in the issuance. There's a book that will be coming out shortly by Bob Schiller, maybe it's come out already, that lays out a large number of alternative mortgages that would manage risk much better for the average American. So the point I want to make is that it would not have taken a lot of thought to come up with better risk products that met the risk needs of most Americans, but that was not what our financial markets were interested in doing. Well, I think I've probably given a little bit of a flavor that I think there's a lot of failures in these markets. It's a plethora of failures. And I'm going to go through them. I want to leave some time for questions, so I'm going to go through them fairly quickly. I'm going to focus, as I say, on three areas. Areas in the lending market, banking, financial markets, and the regulations and macro policy. Within the private financial markets, there again is a whole list of failures. Just in the bad lending, they were lending beyond people's ability to pay, forcing individuals to bear unreasonable risks. As the bubble got worse, and it was very clear the bubble was getting worse, they actually increased the loan-to-value ratios, making the probability of a loss higher. They had loan-to-value ratios in excess of 100%. They lent, what they would tell people was, don't worry. They also had these negative amortization mortgages where at the end of the year you owed more money than you did at the beginning. They said, don't worry, because the price of the house would go up. Now, there's a basic precept in economics that they were violating, which is what? The no free lunch. It was a no free lunch. The more you borrow, the richer you were going to be. And somehow that violates basic equilibrium conditions in economics. But they said, don't worry, you'll be rich. The more you borrow, the richer you'll be. Now, what was particularly peculiar about this was that it was based, as I say, on the presumption that prices would go up and up and up. And this was for mostly housing for low-income Americans. What's been happening to the income of most Americans in the last 9 years? It's been going down. The median income in the United States today is lower than it was in 1999. So most Americans are worse off than they were in 1999. So the people at the bottom were particularly worse off. So, you don't have to say you don't have to have a PhD to figure out that you can't spend more than 100% of your income on housing. And so incomes are going down, prices are going up, you're eventually going to run into a problem. And this is the general result of any bubble. It has to come to an end. People like Greenspan said, how do we know it's a bubble? And yet it was very clear that the prices of housing were bringing them out of the range that most people could afford. They had some other innovations, the no or low documentation loans that became known as the liar loans. And the system was rife with conflicts of interest. I'll give you some examples perhaps later, but you had appraisal companies owned by mortgage originators. So the regulators and investors should have been suspicious. And let me just give you one example of something, if they had taken an elementary finance course, they should have been very suspicious of. Many of the loans, the mortgages, were close to 100% of the value of the house. You just think about what is a non-recourse. You know what a non-recourse loan is? That if you default, the only recourse is to take your house. So these are the idea that if the price goes down, you drop the key off with the lender, the price goes up, you keep the house. Now what is that? A non-recourse mortgage of 100% is essentially an option. It was giving away money to low-income individuals. Now, giving away money to low-income individuals is not the standard part of the business model of most American banks, or any bank around the world, I think. Giving away money to their CEO is one thing, but not to poor people. What were they doing? So what was their business model? Well, the business model was actually a very simple one. They were manufacturing pieces of paper, IOUs, which they were then selling around the world. It was based on a very simple idea that a fool was born every minute, and that globalization had opened up a global market for fools all over the world, and that what they had learned in business school was how to find out these fools wherever they might be. And that is what went on. And as I mentioned before, we're very thankful we found at least about half of them were taken up in Europe. Well, part of what was going on, as I say, was this notion of securitization. That was something that people in finance and economics talked a great deal about as a new panacea. They emphasized the fact that it enhanced the opportunities for diversification. And I sometimes think that my students, when they heard about this great advantages of diversification, ran down to Wall Street to make their money without listening to the other two-thirds of the lecture. If they had stayed around, the second third of the lecture, I would have explained, has to do that diversification only works if you don't have high degrees of correlation. But if you have macroeconomic shocks, interest rates go up, housing prices go down all over the country, that's a correlated shock. If you have a bubble, and it's a national bubble, and it breaks, that's a correlated shock. So that was the first problem, that there that securitization diversification only arises if you have enough low enough correlation. The second problem was that you created new asymmetries of information, new agency problems. Because in the old model, if you created a mortgage, you lent to somebody, if it went bad, who bore the consequence? The lender. But under the new model of securitization, if you sold the mortgage to somebody else, who bore the consequence? The other person. So you could find a fool to buy that mortgage, you didn't bear the consequence. So you created a new asymmetry of information, a new agency problem, and you have inadequate incentives to screen and monitor. In fact, it was interesting. I was reading a paper that I wrote in 1990, published in 1992, at the very beginning of the securitization process, and I suggested in that paper that that securitization process was likely to lead to disaster because they would, I suggested, underestimate the degree of correlation, underestimate the probability of price declines, which is, of course, exactly what happened. But those were not the only problems. They underestimated, for instance, the probabilities. They used normal distributions. And the evidence is that there are a lot of fat-tailed distributions, partly related to systemic risk. once in a century events seem to be happening every decade. And when that happens, you ought to think maybe your model is wrong. But they didn't seem to understand that. They also underestimated the potential consequences of conflicts of interest and the other moral hazard problems that I mentioned before. But I want to emphasize that this does not fully explain what went wrong, because it should have been obvious to the people who were buying these loans, who were buying the securities, that there was something wrong. So yes, you created an asymmetry of information, but the people who were buying it should have known that and should have either put it under controls or discounted the value of the mortgage more. But they didn't. So that's why I say there's a problem of information asymmetry that was at the root of it, but it's also the case that there are lots of irrationalities. The same thing is true if you look at the more formal models used, for instance, by the credit rating agencies, who, as I said before, seem to believe in this financial alchemy. I don't know if you remember the alchemy in the Middle Ages was based on the notion that you could convert lead into gold. And this modern financial alchemy was that you could convert F-rated assets into A-rated assets. And what happened was they made exactly the same kinds of mistakes. One of the things that's interested me is our problems of intellectual incoherence. And you see that throughout the sector. They argued that they had created new products that transformed financial markets, and that was in fact what justified their high compensation. Yet, when it came to modeling, to estimating the probabilities, what did they do? They used data from before the creation of the new products. So they were saying that the probability distributions were the same before and after. They should have said, well, we've changed the world. We've made a difference. It should have had some effect on the prices. It did have some effect. What was the effect? It made these much worse securities. So they should have been aware that they were actually deteriorating the quality. They thought that they were innovating, but they acted as if they had no effect at all in their models that they used in estimation. Another example was that many people in the financial market argued that financial markets were not perfectly efficient, but relatively efficient. They based pricing, many of the pricing, on spanning theorems, yet they also argued that they were creating new products that transformed financial markets, and that was what justified the huge incomes that they were getting. Well, as an economist, I can't not mention something about incentives, and that's obviously a big part of the problem. Incentives matter, but incentives in the financial markets were distorted. There was a focus on short-term profits, asymmetric rewards, which were designed to encourage gambling and succeeded. There was another aspect that's, I think, not gotten as much attention as it should, that the executives were paid by non-transparent stock options. And the reason why that's important is that it encourages distorted accounting. The problem was actually recognized in the early 90s. Actually, some people here at Stanford who were on the Financial Accounting Standards Board tried to change it. I was in the White House at the time. I tried to change it. Arthur Levitt, who was the head of the SEC, tried to change it. But people like Bob Rubin and the other people who were involved in making money fought this very hard because they liked the non-transparent accounting system. And they were making money out of it. And unfortunately, they won, but the country lost. The reason that's such a problem, and I describe this in this book, Roaring '90s, is that it was easier to increase your income. The way you increased your income was to increase your reported returns. And it's often easier to increase reported returns than to increase actual returns. So it's providing an incentive to get distorted accounting. And it certainly played a role. There are other distorted conflicts of interest. The fact that rating agencies are paid by those that they rate, I think it played a role, but probably not the dominant role. There are some other problems. You have to ask the question, why were these moral hazard problems? Why were these problems of incentives? It should have been clear to everybody that these incentives were perverse. Well, then you have to ask the problem. The problem then is not just a problem of incentives. You have to push it at one higher level. It was a problem of corporate governance in the way these incentive structures are created. There were other problems. The moral hazard problem was created by the history of bailouts. And this was particularly bad because of the banks had been allowed to grow so big that they were too big to fail. And they knew that they were too big to fail. And when you're too big to fail, what does that mean? It means if you gamble and you win, you walk away. If you gamble and you lose, the taxpayers pick up the losses. So we had created an environment where we had created incentives for them to behave in this irresponsible way. But again, it's hard to reconcile this fully with rational markets, because investors should have recognized the nature of these perverse incentives and the consequences. Well, maybe, as I said, there's such a plethora of problems, it's hard to know where to stop. Derivatives are another one where, let me just mention one example of the kind of intellectual incoherence that was so strong. One of the problems with derivatives is the importance of counterparty risk. That is to say, the party that you've engaged with won't be able to fulfill the contract. One of the questions, if you look at, you see these numbers, huge amounts of outstanding derivatives. And the question is, how did that get to be so large? And the answer was the following, that if Bank A took out an insurance policy with Bank B on an event related to firm C, say, then the next day if they decided to cancel it, they didn't cancel it. What they did is they went to a negative of the first contract. In other words, you had a plus X and a minus X, and they canceled, rather than canceling the contract. Okay, so both of them were standing, but they thought that the plus and the minus canceled, and they were netted out. And that's true except for one detail, which is what? Bankruptcy. Because if A owes B money and B owes A money and B goes bankrupt, they're no longer symmetric. They no longer cancel out. A still has to pay B, but B can't pay A. So what netted out didn't net out if you had a risk of bankruptcy. You ask the guys, why didn't you net out? Why didn't you, why did you let these numbers get so gross? Why did you fail to net out? The answer you get back was, we never thought anybody would go bankrupt. But then you asked them, what were you betting on? They were betting on the bankruptcy of each other. So they have this schizophrenia mind. They were engaged in betting on they were betting on whether J.P. Morgan or Bear Stearns was going to bankrupt, and they were acting as if the probability of bankruptcy was zero. Now you try to figure that out. Deep psychiatry is the only way you can figure that out. Well. As I say, there's a long list. I just try to touch of the failures that have contributed to the problem on the market side. But there are also a large number of failures on the regulatory side. The basic notion is there is a need for regulation. Whenever there are externalities, the failure of the financial market causes serious problems, as we've seen, and therefore something should have been done. One of the problems is that we have regulators who didn't believe in regulation. They were chosen because they didn't believe in regulation. Volcker was fired. I don't know if you remember that, by President Reagan. Why? Volcker had actually brought down inflation rates from double-digit levels to very low levels. For a central banker, that should have given him an A triple plus. He should have been rewarded. He was fired. Why? Because he believed that there was an appropriate role for regulation. And Reagan wanted somebody who did not believe in regulation, and he got somebody who didn't believe in regulation. There's a lot of discussion about regulatory capture, about the influence of special interests. But I think the regulatory capture model provides too simplistic model of what happened. There was a party going on, and no one wanted to be a party pooper. The model, the metaphor that people have used is that what the role of the regulator is to take away the punch bowl when the party gets too rowdy so that the rest of us don't have to clean up. And what Greenspan did was keep refilling the punch bowl and making it more alcoholic. I think to understand this, you have to go beyond simple kind of normal political economy. It wasn't that he was getting of capture. It was part of the mindset of the time. As I said, there are three critical ingredients I've been trying to focus on. One is bad lending. The second is the flawed regulation. I want to spend a moment on loose monetary policy, and it was the mixture of the three that was explosive. I could go through with a large number of specific things where Greenspan and the Fed made mistakes. They encouraged people to take out variable rate mortgages when the interest rates were at the low. He made statements like, if you had taken out a variable rate mortgage a decade ago, you would have been a lot better off. But that was because no one ever believed that interest rates would ever go down to 1%. When they're at 1%, what is true? What is likely to happen to interest rates? Go up. And so if you're borrowing the maximum at 1%, it's likely they're going to wind up with a problem. And yet he encouraged them to take out variable rate mortgages. He denied there was any ability to ascertain that there was a bubble. You can't be sure, but what can be true? There's statistical models that can say, what is the likelihood that there's a bubble? And he could have done that work. There were statistical work that had shown that was the case. They believed in self-regulation, which I think is an oxymoron. But in any case, you can't take into account in self-regulation interactions arising from banks simultaneously following similar policies, giving rise to systemic risk. In a way, part of the problem was that central banks were focused on models centered on second-order problems, the micro misallocations that occur when relative prices get misaligned as a result of inflation. Many of you may have studied these models of inflation, led to the view that there ought to be inflation targeting. But these are really second order is to give too much credence to them. The 10th order effects compared to the consequences of allowing the financial sector to become frail and fragile, and the consequences that we're facing. Well, how much more time? Oh, I want to open up for questions then. Let me just say things were really bad, and because we've let the people who got us into the mess try to get us out of the mess, they've not done a very good job. They didn't understand things before, they didn't see it coming, and now they're not doing a very good job getting us out. And it's really quite sad for those of you who are in the job market. So let me just open. It's a really difficult problem fixing the financial market, getting the credit flow going, but the way we've been doing it hasn't worked, and there really need to be a fundamental reform in the way that we've been doing it. We have to address the foreclosure problem, And we have to have an effective stimulus, which means relatively little emphasis on tax cuts unless they're related to investment. So that's my brief policy prescription, plus regulations to change the incentives of those in the financial markets so they don't undertake the same kind of bad behavior that they've had in the past. Thank you. We are benefiting a little bit relative to the developing countries because of the flow of capital back to the United States, but I don't think that's going to be permanent. So to answer your question, I think the part I didn't get a chance to go through is that I do think the U.S. Is facing some very long-term problems that have not been talked about. The fundamental one is the one that you mentioned. What has kept the U.S. economy going for the last 5 years, actually longer? A series of bubbles. Tech bubble followed by a housing bubble. That led to consumption, a savings rate in the United States of 0. And that means that going forward, it's very likely that our savings rate will go up significantly, 4, 5, 6%, still low by other countries' standard. In the case of the Swedish crisis, the change in the savings rate was 13 percentage points. We probably won't do it. But the consequence of that is that there's a big hole in aggregate demand that will have to be filled. Government will be doing that a little bit for a couple of years, but because of the size of our national debt, there'll be constraints on the willingness to do this. And what's so important is to realize this goes beyond all the credit problems, all the problems of fixing the financial system. Once we fix the financial system, this problem is still going to be there. And that's why I am very pessimistic that even after, say, we fix these immediate crises going forward, there is this question, are we going to just go into another bubble, or are we going to be able to address the underlying problems? Now, what are let me say, there are two underlying problems very briefly. One of them is there's been a very big increase in inequality in the United States and most countries around the world. What that means is that you've redistributed money from those who would like to spend to those who have more than they need to spend. We solve the problem of increasing inequality by allowing the poor to spend beyond their means through this housing bubble. But that game is over. It's going to have very strong implications for our society. But so that's the first problem. This large inequality leads to low aggregate demand. The second one is a problem in global imbalances that was discussed a lot 5 years ago, but is actually at the root part of the problem in the United States. So our problem of imports exceeding exports is part of you have to look at this as a global macroeconomic system, a global general equilibrium. And the only way that that's going to be addressed is by a reform in the global reserve system, which is another big topic. But these are two things that are the underlying factors that have not really been addressed by anybody in the political scene. I mean, you're raising a couple of very interesting questions. One of them, it is very worrisome that some of the things we're trying to do to get us out of the crisis are actually exacerbating the problems. We're consolidating banks, and we had banks that were too big to fail now, and we're making banks even bigger, even more too big to fail. So that should make us uneasy. The magnitude of the problem of what has happened in the Federal Reserve in the last 2 months, I don't think is widely appreciated. The balance sheet of the Federal Reserve has gone from around $800 billion to around $3 trillion of garbage. So what we've done is we have two bailouts going on simultaneously. The TARP, which is the public one, which is called the troubled asset, which is a little bit of a euphemism. I don't want to, toxic, garbage. But that's the open one. But the hidden one is through the Fed, which has taken on, has become not the lender of last resort, but the lender of first resort. And that's very deeply troubling from both a democratic political process and from an economic process. We don't know how bad the assets are and on what terms they've taken them on, and therefore what risks we face on our public balance sheet. So, but the part of the concern is it's not working in terms of rejuvenating credit. And that's why the attention, and it's not working not only here, but also in the UK. And then the question is, why? And part of that, to understand why, you have to understand how banks work and the change in the banking system from the Great Depression until today. And there have been very dramatic changes, and what we've been doing is not really created an environment in which it is in the interest of the banks to lend. And let me just make one point about that, because I made a big point about saying that one of the problems is that got us into the mess is the misalignment between social returns and private rewards that was pervasive in the financial industry. Well, we've made that problem much worse, because who is now the major owner of all the banks in the United States? Almost all the banks, all the major banks. We as a share, we put in some of the banks, we have about 90% of the capital. Some we have only 50%, but we are the majority. What is our role in management? Zero. What is the public interest? To get the banks to lend. What is the private interest? To maximize the return of the old shareholders, not we as the government shareholders. So there's a total conflict of interest, and it's perfectly understandable. Think of if you've got a big injection of capital, you face all these risks, you know the economy's going into a recession, maybe into a depression, you're worried. What would you do? It makes sense to just sit still, not lend, and hope that all your rivals die and you'll be the one guy standing in 2 years' time. So why undertake a more gamble? Any loan is risky in this environment. So it's pretty understandable why they haven't been lending. And it's clear that there's a clear conflict of interest, the discrepancy between ownership and control. The question is, who is bailing out? And it goes back to what I said about the Mexican bailout. The Mexico bailout wasn't a bailout of Mexico, it was a bailout of Wall Street. So you have to ask, who is going to be the winners, who's bearing the cost? Okay? And the argument that I put forward is that what we should have done is, and we are gradually going there, is a version of a Chapter 11 for the auto industry. And with the government providing some assistance to the company after in the process of restructuring, some guarantees, because the people are worried that the suppliers won't give parts if they aren't assured that they will be able to pay for them. So you need, in this context, there is a market failure. You need a role for guarantees. Okay. And it probably needs more capital. The kind of proposal where you just give it money is basically a bailout for the bondholders and the shareholders. Not of the automobile companies, it's the bondholders and the shareholders. It's not the workers, it's not the... And that's the critical... If you force them, if you force the equity owners to write that down to zero, the bondholders become the equity owners with the government capital injection, you then have taken away a large amount of the fixed liabilities that the company has, and they can become more profitable. So The real issue here is many people in Wall Street obviously were not happy about having the bondholders lose. And so what was interesting in the politics of this is that there was the right was against the bailout because they don't believe in bailouts at all. It was ideologically, they really opposed it. And the left was against it because they didn't think we should be bailing out investors and bondholders. We should be giving money to the union, to the workers to try to keep the company going. And it was in the center where you had the influence of Wall Street, and the two extremes stopped the bailout going through Congress, but then they used the TARP money to bail it out. But when it was done, with the notion that they would be working towards some version of a Chapter 11.